We've gone over the basics of what options are, but how is the price of an option even determined? Supply and demand is the most fundamental answer to that question, but there's more that defines the pricing of an option than supply and demand can explain. It is because of the nature of options, the choice of either buying the option or selling the obligation, plus the limited time frame of the contract, that begins to set the prices of options. When you typically think of the price of a stock, chances are you picture in your head a green and red bar chart wiggling its way across the screen from left to right. Each bar represents the range of a price that the stock has visited in the past minute or day or week, depending on the time scale that the chart is set for. For options, rather than a chart, you get multiple lists of numbers. Remember that options consist of strike prices. Strike prices form the backbone of how we structure the pricing of options. To the left side of the strike price list are the available prices of calls, and on the right side are the prices of puts. But don't forget, options also consist of expiration periods, so now we need to replicate that list of strike prices for calls and puts, changing the date of the expiration for each time period. Only then will we have a more complete picture of what prices various options will go for. Collectively, all of these parts, the lists of call strikes and put strikes replicated across time, is called the options chain. You can think of an options chain as sort of a menu of strikes and date choices. Each combination of strike and date and call or put is given a price that you can buy or sell the option for. The prices of calls and puts in the option chain are split into a bid and an ask. You can think of the bid as the wholesale value option and the ask as the retail price. The bid-ask spread is not unique to options. It is common throughout all sorts of markets, including just basic stock trading. Under the most basic of trading situations, you will sell options at the lower price, the bid, and you will buy options at the higher price, the ask. There are ways around this using what are called limit orders to manage your trades, but even then, you may not necessarily get the pricing you want. A lot of that depends on other factors that surround a particular stock and its options chain. The reason there is a bid and ask is in between you and the opposite party of the exchange is someone known as the market maker. Market makers are specialty traders who facilitate the easy flow of options opportunities. They make their money off the difference between the bid and the ask. Without them, the market would probably grind to a halt as buyers and sellers stubbornly hold out for their desired prices, never trading with one another. Market makers are essentially creating liquidity in the overall market. Market makers set the spread based on supply and demand. Illiquid stocks usually have to have a much wider spread on their options because they're simply harder for the market makers to facilitate trade. And the market makers need to be fairly compensated, so they increase or decrease the spread according to the availability of traders who want to make a trade. More liquid stocks imply that there are more traders, so more trades can happen in a shorter period of time, and the spread between the bid and ask can shrink. As a trader, if you are not conscientious about how you trade, you can lose a lot of money on the bid-ask spread. This is known as slippage. Strikes may be $1, $5, or $10 apart, sometimes even fractionally in between, such as $2.50 apart. Strike prices may or may not be consistent throughout the options chain and even between expiration periods. Strike choices will change even more as an expiration period approaches its last day. With regards to expirations, for most stocks they occur at monthly intervals, but highly liquid stocks can have weekly expirations and some indices have daily expirations. What strikes and expiration periods are available in any given week all depend on what the market makers determine need to happen. There are a series of complex underlying mathematical models that ensure the pricing is not completely arbitrary. However, pricing is ultimately a function of supply and demand in conjunction with volatility, volume, and the always encroaching expiration date. All of these elements are highly reflected in the parts that make up the options chain and the options price. The value of an option is essentially broken into two parts, intrinsic and extrinsic. Intrinsic is pretty straightforward and differs for puts and calls. The call option intrinsic value is the current stock price minus the strike price, with a minimum of course $0. Put option intrinsic value is the strike price less the current stock price, minimum of $0. If the resulting number is positive, then the position is considered in the money, which we'll talk about later, and is worth something to the buyer of the option, especially if it is considerably deep in the money. A call option on Apple with a strike price of $250 has an intrinsic value if the current price of the apple happens to be greater than $250, say $280. The buyer may choose to exercise their options for the $30 difference before or at expiration. Extrinsic, on the other hand, is the amount of value in the option that is in excess of the intrinsic. Think of the intrinsic as the base value of the option and extrinsic the premium add-on to the option. Intrinsic value is lost on calls if the stock drops, while put options gain. Puts lose if the stock price rises, while the call options gain. If, from our example above, the stock price of Apple was $220, then the extrinsic value would be $0 because 220 minus 250 is negative $30, and we can only have a minimum of 0. Such call options are considered worthless. Where does extrinsic value come from? It comes from time and volatility. The more time left on an option, the more valuable it is because there is greater opportunity for the holder strategy to fall into line. The more volatile stock is, the more valuable it is because of the excessive fear in the market which drives prices up. The concept of intrinsic and extrinsic may seem academic to most new traders. For some, it's simply easier to remember that short puts are out of the money when below the spot price and short calls are out of the money when above the spot price. Thoroughly understanding the underlying concept will allow a trader to see deeper into when and why to open or close an options position. Traders are in the business of making a profit, and the concepts of intrinsic, extrinsic, short, and long demonstrate the flow of money as the option chain approaches expiration and the underlying stock positions change in price. We've covered some solid fundamentals regarding options in this video. Options are derivatives, yes, but they are not abstract. Underneath your digital trading platform of choice are actual contracts that must be fulfilled when conditions are met. Options become viscerally real when looking at the options chain and all the basic information is laid bare. The bid-ask price is set by the market makers. The moneyness of the option, showing whether or not they have intrinsic value associated with them. All options have extrinsic value associated with them, that is, up until expiration. And extrinsic value is determined by time value and volatility. Understanding time value and volatility are central parts of options trading and what we'll get into next. They are at the heart of the mathematical models that establish the pricing of options. All options have time value because they expire. Traders have a limited window with which to make a decision, and volatility of the underlying is another pressure put on the price. Not only does the price of the underlying change as it moves up and down, but how erratically and under what conditions it moves can also add or subtract value from an option.